It's not a happy occasion for us to be ending the year, the calendar year, and our financial year with news of a further downgrade of the Caribbean Development Bank's credit rating. We had a press conference earlier in the year when both Moody's and Standard & Poor's had reduced CDB's credit rating from the AAA level that it was. And on that occasion, both rating agencies had identified a number of factors as the basis for the downgrade. Those factors could be classified into two components. One were internal issues. The other could be classified as exogenous or external to the institution. Naturally, we felt that as a management, our priority was to focus on addressing the issues that were within our immediate control, that is the internal issues. What were those internal issues? First, the rating agencies had expressed discomfort with the fact that in a very difficult international financial environment, CDB had changed the profile of its borrowing on a temporary basis, by which I mean we had departed from what was the norm over many years of borrowing long-dated issues which matched our assets and liabilities. In other words, CDB tends to lend long to its borrowing member countries, and therefore we tend to borrow resources long in order to have some kind of a matching of those two components. The reason we did the short-term borrowings was because the international capital markets, where we go for a good proportion of our funding, those markets were not favorable to long-dated issues. What we recently discovered is that many of our colleague multilateral institutions were doing precisely the same thing for the same reasons that we did it. The problem, as the rating agencies saw it, was that we had a large number of bonds maturing in a relatively short period of time, and they felt that that represented what is referred to in the business as rollover risk. Rollover risk being the concern that you might not be able to raise the resources that are needed to pay out your bondholders at the time when those resources are absolutely needed. So what CDB did was we moved with alacrity to ensure that we put in place the documentation that was necessary to go to the market and secure those resources. Let me quickly add that a few weeks ago, CDB was successful in raising on the international capital markets $300 million in new cash, and that cash we were able to secure a structure for the bond associated with it that is repayable in 15 years. The maturity is 15 years, and it has an amortizing component to it, which is one of the features that the rating agencies wanted to see, where we start to repay that loan, that borrowing, 5 years before its full maturity. So that what that has done is it has effectively put to bed the liquidity concern that the rating agencies had. So we fixed that first internal problem. The second internal problem which they had identified was that they were of the view that for an institution that had a AAA rating, our risk management infrastructure was not adequate. So what did we do? We went out and we hired one of the best consulting firms in the risk management business. They have been in the bank for the last 5 to 6 months, Adrian, I believe, and they have been engaged in what is referred to as a gap analysis. They've been looking at what best practice would represent in the business of risk management for an institution like ours, and they've used that as a benchmark against which to measure what we have. They have identified a number of gaps, and they have outlined a series of recommendations. I believe it's in the order of 14 recommendations which CDB could pursue in order to close that gap. Our expectation is that the reform process in relation to risk management will be completed by about the end of the first quarter next year. In short, what it recommends is that we create a dedicated risk management unit which would pull together many of the risk management procedures and policies that CDB has had in place almost since inception, but which have been developed and modified over the years. The point is that we need to have a focal point on risk management in CDB, and we are a far way down the road in getting that structure in place. We're also going to be hiring a chief risk officer who would have overall responsibility for reporting on risk matters. So we have addressed internally the two main issues that were identified by the rating agencies as the principal reasons for the downgrade of the institution earlier this year. The other factor that the rating agencies pointed to were weaknesses in our external environment. By that I mean, in particular, weaknesses in the countries to whom we lend, and also developing weaknesses in the countries who don't borrow from CDB, but on whose capital we rely when we go to the markets. They had flagged these as potential problems. We have little or less control over those external environmental factors than we have over the internal ones. The question therefore arises, why is it less than 6 months later we have faced a further downgrade from Standard & Poor's? I believe the answer is twofold. First, in the rating letters that were issued, in the rating letter that was issued by Standard & Poor's earlier this year, they intimated that they had embarked on an internal exercise that is internal to Standard & Poor's, whereby they were re-examining the methodology that they use in order to rate multilateral institutions like ourselves. And they intimated in that rating letter that once they had concluded the exercise, it could lead to either an upgrade or a downgrade, a further downgrade in CDB's credit rating. We met with them a few weeks ago, and during the course of the discussions, it became very clear to us that the final version of that new methodology was not going to be favorable to CDB. And the principal factor, the principal new component of that rating methodology that has been detrimental to CDB is a greater emphasis now being placed on what is referred to as concentration risk in your lending portfolio. What do we mean by concentration risk? Concentration risk means that you have a disproportionate share of your loan portfolio focused on a relatively small number of customers. So there's what you might call on this occasion bunching in the lending portfolio as opposed to bunching in the borrowing portfolio. Now, this is not new. This is not a new development. CDB has always had bunching, and there's a very good reason for it. There are two reasons in the main. One is the fact that we're operating in a very small region, and we primarily lend to sovereigns, sovereigns meaning governments. There are only 18 countries that we can lend to because we only have 18 borrowing members. So by its very nature, you're going to have a relatively small number of countries to whom to lend. What it also means is that we also have a mandate as a development institution to focus mostly on those countries that are in the greatest need. So, within our membership, we have the Trinidad and Tobagos, we have the Cayman Islands, we have the Bahamas, and a number of other countries, the British Virgin Islands, which have very, very high per capita GDPs, and in many respects are good credit quality. So if we had our druthers, and if we were just bankers, we would want to lend primarily to those countries. But that's not our mission. That is not our mission. Our mission is to be a developmental institution. So we focus on those countries who need us the most. The sting in the tail, therefore, is that there's an inherent tendency for concentration. And that has turned out to be one of the difficulties that we have with the new rating methodology. And Standard & Poor's has admitted that this new rating methodology is more skewed to the capital adequacy type modeling that is associated with commercial banks. So that has hurt us. Now, why is it wouldn't hurt an institution like the World Bank as much as it would hurt CDB? Because the World Bank, and its name gives it away, they lend to the world. Their portfolio can be diversified geographically across several countries. They don't have 18 borrowing member countries like us. I don't know offhand how many they have, but it's legion. So inherently, the World Bank has an opportunity to be less concentrated than CDB. They'll be more concentrated than a global commercial bank. Okay? But CDB is going to be even more concentrated than the World Bank. So that has been part of the penalty that we have faced. The other factor that has come into play now is that a number of our countries, a couple of our countries have found themselves in a position where they're having difficulty meeting their obligations on the repayment of their loans. They have fallen behind the schedule of payments that are required. That does not play well with the rating agencies. The other factor is that one of our countries has also paid another set of creditors before they have paid CDB, and that is a violation of what is referred to as preferred creditor status, which is a status enjoyed by all multilateral institutions like CDB. Preferred creditor status means if a country runs into difficulty paying its creditors, it puts CDB at the head of the line. In other words, we are treated like a senior lender, and therefore they pay us before they pay others. One of our countries found themselves in the situation where they chose to pay another set of creditors before CDB. So that was another negative as far as we were concerned. The final factor is CDB got a general capital increase, which is, in the parlance of the private sector, the equivalent of a rights issue. We asked our shareholders to give us new capital because our lending needs were increasing, and therefore we needed more capital to back the new lending. So what we do is we allow our shareholders to pay in their cash capital over a period of 6 years. But we have scheduled times within which they have to pay in those that capital. What has happened is that a number of those shareholders have fallen behind in the scheduled payment of that capital, and that is regarded by the rating agencies as a reduced support for the institution by its shareholders. So those are the factors that have led to the downgrade of CDB from AA+ with a stable rating to AA with a negative rating. Is it the end? Is it the end of the world? The answer simply is no. If you read, I don't think you need to even read it very carefully, the release that has been put out by Standard & Poor's, and I believe you all have it. It's in the public domain. What it says very clearly is that CDB remains a very strong financial institution. In fact, Standard & Poor's have indicated to us that where we are today, we're stronger. We have a stronger credit rating than 98% of the commercial banks in the world, not in the Caribbean, in the world. So that by any measure, we still remain a very strong financial institution. But you're not going to see any of us in this room jumping up and cheering about the fact that our credit rating has been lowered, because it's not a happy consequence. And we just completed a meeting with our directors this week, and we've had a very, very frank dialogue with them about the responsibilities of the management and the responsibilities of the shareholders in ensuring that CDB remains a strong credit. The importance of us remaining a strong credit is that we are able to continue to be of value in the developmental efforts of all of our borrowing member countries.